everyone, good evening. You're watching The Money Show on ET now with me, Mubina Kapasi. This is the Rise with India Prime Time, and this is your one-stop shop where we get you all the important money matters that you need to keep yourself abreast with. And of course, we also take viewer queries on the show. So if you have any questions or queries on personal finance matters, we will be addressing them. Let's tell you what's lined up on the show. First up, we have that very scary GDP number of 5% that has come up. And also, you guys may have just received your salary. This is not the right time to simply blow it away or act a little more generous with your salary, because you need to ensure that you are investing your salary in the correct avenues when you receive them. Also, like I said, that very scary GDP number of 5%, I'm sure it spooked a lot of you. I'm sure you may have got a lot of WhatsApp forwards about how the Indian economy is in a complete turmoil. Don't panic. We at ET Now and we on The Money Show will tell you what is it that mutual fund investors should watch out for when the Indian economy is in a situation like this. Later on the show, it's not just the markets, but also the Indian rupee that has been depreciating tremendously versus the US dollar. So how to manage foreign education, especially when we are just kickstarting a brand new academic year amid the entire weak rupee. I'll be joined by Anshuman Mishra of Loan Adda for the same. And finally, ahead of the upcoming festive season sales, we have a whole host of new cars that are set to launch. Auto sales, of course, have been weak, but let's see if these new launches do perk any interest from our buyers. We will be joined by none other than Hormuz Sarabji of Autocar to show us which cars is he cherry picking. Well, first, let's take you through the headlines at this hour. It's an absolute bloodbath on the Lal streets. The Nifty and the Sensex tank, with the Nifty losing more than 1% and the Sensex has tanked more than 500 points. The mid and the small cap index as well lose more than 1% in trade. The rupee too slips beyond 72. Dismal GDP data, slowing core sector growth and stuttering manufacturing PMI send alarm bells ringing. Brokerage firms slash India's GDP forecast after it slumped to a 6-year low of 5% in the first quarter. Economists see pressure on RBI to dish out deeper rate cuts to push consumption. Meanwhile, Motown continues to reel under the pressure of declining sales. Don't expect a spectacular rebound in growth very soon, says PMEAC Chairman Vivek Debroy. Speaking exclusively to ET Now, Debroy asks to brace for a few more quarters of sluggish growth, but insists that this is not a recession. Debroy also says that the bank merger is a good step towards reviving valuations of state-run banks. The government approves hiking the procurement price of ethanol used for fuel blending. Also gives a nod to pump in around 9,000 crores into IDBI Bank to raise its capital adequacy ratio. A partial relief could be in the offing for the auto sector. Top sources tell ET Now that high-level discussions are underway to reduce the tax incidence on hybrid vehicles. Fitment Committee may look to do away with the 15% cess. RIL jumps on the realty bandwagon. The conglomerate invites bookings for model economic township. Anchor clients include names like Panasonic, All Cargo and Reliance Retail. It's also learned to be in talks with marquee global MNCs for India campuses. That's an ET Now exclusive. Massive fire at the ONGC plant near Navi Mumbai kills 4 people. Several others injured. CNG and PNG supplies take a major hit. Government asks industries to switch to alternate fuel in the meantime. Well, those are the big headlines that we are tracking for you this evening on ET Now. But back to the money show. And like I told you, today we are going to be discussing about the whole gloomy scenario that everyone seems to be painting for the Indian economy. And as mutual fund investors, you have invested in stocks that well represent the Indian economy. So how worried should you really be if the economy is growing at only at 5%? That's the slowest growth number in 6 years. Not just that, it's the beginning of the month and I'm sure many of you guys have just received your salary. Well, don't blow it away, as we on the Money Show always tell you. Make the right investment decisions with the help of the Money Show. So to help me with all of this, I have with me right here in the Mumbai studios, Pankaj Mathpal, MD of Optima Money Managers.
Thank you.
Pankaj, thank you for joining us on ET Now. Let's start off with the first topic. You know, in fact, just earlier this morning, I was talking to somebody who said, I got this text message saying that the Indian economy is in complete turmoil and, you know, we are slumping, auto sales are falling and, you know, etc., etc. All kind of things are happening. So should I stop my SIPs? I mean, I'm sure your clients as well may have asked you this question every day. Okay,
correct.
Great. So it clearly paints a very, very gloomy picture. However, as a mutual fund investor, I naturally do have a reason to be worried. But the question is, should I be so worried that I literally pull the plug off my investments?
No, see, I agree with you because investor sentiments are down and the GDP number, especially because 5%, which is lowest in last 6 years. So it has impacted the already bad sentiments further. But I'll say when you invest in mutual funds, your time horizon is longer and your objective investment is to achieve something, to some goal. So if you have invested to achieve some goal, you have decided that how long you'll stay invested. So because this kind of things will keep happening and it's not the first time. See, if we see the cycles, we have always seen the markets go up, down. But if you have invested, especially in equity, then your time horizon should be longer. And when the markets are down, it's the opportunity for you. I understand that sector-wise, if you see that most of sectors are down and almost all the industries are going through the tough phase. But still, I'll say government is taking corrective actions. It will have the positive impact in future. So if you are buying something at the lower price, it is an opportunity for you. And especially when you're talking about the SIP is meant for that. Whenever market comes down, you get more units.
Yeah.
So there's no reason for you to stop your SIP or asking that whether I should cancel SIP or I should exit from the mutual funds. I'll say that if you're not started, even you start now investing in SIPs and continue your SIPs for long term.
Yeah, that's the benefit of SIPs, right?
Definitely.
It picks up units at every stage in the market, even when the market is down. So for that same amount that you will be investing, you'll actually be getting more units. Just take it as a discount, right? You go to the shopping mall when you know there's a discount. So markets as well do tend to throw up such similar opportunities. Pankaj, now the second question. A lot of our investors who may be salaried have just received their salary, and the temptation, of course, is to, you know, simply, and we had the long weekend, right? We had the Ganesh Chaturthi weekend. The temptation, of course, is to blow it off. We have another long weekend as well coming. However, like we always say, you know, investing your salary wisely is something that's really important.
Definitely.
So what would you recommend investors should do, salaried employees should do now that they've just received that fresh chunk of salary?
See, usually what people do, they earn, spend, whatever is left, they save. But I'll say that you, whatever earn, first save for your future goals. And as your salary has come, decide that for what you want to invest. And your long term, short term, first thing, most important, your financial goals should be decided before investing. But yes, if you are not very sure about that, at least time horizon you should know, because there are different kind of investment. Some are have some little bit more risk, but can give you more returns in long term. When you want to invest for short term, you would like to have some fixed income instruments or the schemes which give you guaranteed returns, which may not be very high. So, or for contingency, you want to save something. So decide that for what you want to invest, how much time you have, and then have the proper asset allocation. We always emphasize on mutual funds because that gives you opportunity to invest in different asset classes like equity, debt, or hybrid. But at the same time, you can also invest in some RD or anything. But most important thing that as once you decide what for your investing, accordingly decide the scheme. And mutual fund SIP is always good because it gives you choice. to invest for different objective of investments.
So let's assume, Mr. Mathpal, that I'm your average salaried Joe. My age is between 25 and 32 approximately. I get my salary every year in my savings account, and yeah, the natural practice is to just put it in fixed deposits, okay? Because it's a very simple process as well, just a simple click of the button. However, how would you recommend then, if I have to break up my salary percentage-wise, what should the ideal percentage be if I'm investing simply for long-term, for retirement, for in general wealth creation? What should my ideal bifurcation be?
See, when you said 25, 30-year range, I'll say first thing, your goals will be dynamic. Because at this stage, there will be many things and you'll keep changing your goals, so financial goals also.
True.
So considering that fact, I'll say that if you can save 30-40% of your salary at least, and out of that, except only for contingency what you want to keep, rest you should invest for long term, because earlier you start, it becomes easier to accumulate the big wealth. So out of that, if you're saving 30-40%, I'll say at least 20-25% should go in equity for long term. And if you have something in mind which is coming within 5 years, for that RD will be a good choice, or some debt oriented mutual funds. But for long term, I'll say that you start with the equity mutual funds, maybe the 3-4 schemes you start with through SIP route, I mean. And for short term, as I said, you can start with the RD also of 1 year, 2 year, which will not give you very high returns. That will be taxable also. But at the same time, because we have seen that equity or debt, these are volatile, and you need something which gives you guarantee also. So for something you can keep in RD. But as I said, out of that, whatever 30-40% you are saving, more chunk should go in equity for long term.
Okay, all right. So you've just got your salary and the market has fallen. I think it's the ideal concoction for you to invest in SIPs if you still haven't. And we on The Money Show are, of course, always here to guide you through how to select your SIPs and to always periodically review your mutual funds. And on that note, let me kickstart Ask The Money Show, which is our forum to invite all the questions and queries that we receive from our viewers. The number will appear on the top of your screens. There it is, 24990388. Or you can email us on themoneyshow@etnow.tv. Let's take on board our very first question. It should appear right here on our screens. We have Anirudh Mukherjee, who has written in to us. He says, my wife and I are NRIs with savings of approximately 65 odd lakh rupees, and we intend to simply get the maximum returns out of the same. Now, he essentially wants to know what are the ways we can divide the sum up so as to get the maximum return. Unfortunately, I don't think he had mentioned his age, or that would give more perspective. But let's assume both ways. He's between that age bracket of 30, 40, approximately 45, or he is maybe in the older age bracket. In both the situations, how would you advise Anirudh to go about his investments? And of course, he's an NRI.
See, everybody says that he wants to generate maximum return. That's a common thing.
Yeah.
But because the returns come with a risk also.
Yeah.
So if your objective investment, time horizon, and your risk appetite is known, it becomes easier to suggest some scheme. But as you gave two options, like the young person of 30 years or the old age, I'll say if you are young and you have time means to achieve those goals, then your higher allocation should be in equity. Maybe that 70-80% goes in equity and rest goes in debt. But if you are like 40-50 years old, because if you lose some capital, you have limited time to recover that. So in that case, I will say that if 40%, 50% going in equity and balance in debt, that will be a better choice. At the same time, when I say equity and debt, debt does not mean only debt-oriented mutual funds, because in mutual funds, whether it's equity or debt, capital is not protected. So I will suggest when you want to invest 65 lakh, out of that, some amount should be invested in such a way, whether it's a fixed deposit, it's a bonds, debenture. These days, we are getting many choices of even non-convertible debenture. So NCDs is also a choice. Bonds are there in the market. In secondary market also you can buy bonds. So you should include bonds, debenture in your portfolio, which will give you guaranteed returns. But at the same time, because we know equity has potential to create wealth in long term, and even debt mutual funds from the tax planning perspective are the better choice compared to your fixed deposit. So you should have allocation in that. So as your age, your objective investment, you decide it. But yes, your 40-50% allocation equity must be there if you are in the higher age, or otherwise it should be higher than that.
Okay, all right. So as your age advances, it's better to sort of mix up your product portfolio in favor of debt and slowly cull down your equity exposure. Because like we always say, right, equity mutual funds are long-term instruments. You cannot expect to redeem them in 2 years and 3 years. That is not really, is not the optimum solution. I think we have a live caller joining us. Is that right? Okay, let's take up the next question. We have Venu S who has sent in a query. He has sent it to us via email. He asks, can you tell us how to analyze mutual funds? I have been investing approximately 15,000 rupees every month for the past 2 years, and this has been in the Reliance Large Cap Fund. He wants to know if you could share your opinion about the performance of this fund. Now, unfortunately, it's only one fund, 15,000 rupees in the last 2 years, which means he's invested quite a meaty sum up until now, more than 3 lakh rupees so far, if we have to take only his SIP investments. Firstly, it's only one fund. Would you advise him to do that? And secondly, of course, the other question, how do you analyze mutual funds? So if you could share your views on that.
Yeah. See, first thing, when you invest, you should have the proper allocation between the large cap, mid cap.
Yeah.
Even if you are a long-term investor investing for more than 10 years, a small allocation in the small cap will also be a good choice. So only investing in large cap, because when there is a rally in the market, we always see mid cap, small cap outperform the large cap. Second thing, if you're investing large cap also, the big amount better divide in 2-3 schemes. Why only one scheme? Because every fund manager has a different style of investment, and sometimes it gives you different returns. So if you see Reliance large cap fund, its performance in long term was good, but if you see the last 1 year, it's consistently underperforming its benchmark. So I'll say that if you can, if you switch to some other better performing fund like ICICI Prudential Blue Chip Fund or Mirae Asset Large Cap Fund, that will be a better choice for you. Second thing, as you asked that how to analyze the fund, see, it is very important, first and foremost thing, that you should compare the performance with its benchmark. Because when we invest in the actively managed fund, the most important is that fund should deliver better return compared to the benchmark. So if that is not happening, so it means the choice of stocks in the portfolio is not correct. That is one. Second thing, that how much risk has been taken in the portfolio. See, we see it the alpha of the scheme. So alpha tells us, Jensen alpha, that how much extra return have been generated with same degree of risk. See, if extra risk has been taken to deliver the extra returns, it means it's not the wisdom of fund manager. That is because of higher risk. But so alpha should be positive. That is another thing. Then there are ratios like Sortino or Sharpe ratio, which tell you that whether the returns have come because of the good choice of stocks by the fund manager, or it is because of excess risk taken in the portfolio.
But
so
where do these ratios, are these ratios disclosed by the mutual fund?
Yes, yes.
Okay.
If you go to the fund fact sheet of any mutual fund or on the websites, which gives you comparison of the schemes, these all things are like alpha, beta, standard deviation, Sharpe ratio, these all are available there. So you must say this, and when you compare two schemes, it should be from the same category. Sometimes people compare small cap with mid cap. That is not the right comparison even. So these basic things you must see before investing.
Okay, lots of them, and I suppose we should have a master class as well on how to analyze mutual funds, because there are a lot of these terminologies which may sound very alien to the layman, but yeah, it's a good practice to know all of these terms. Okay, we have Mr. Prakash who's joining us on the phone line from Pune. Hi Prakash, good evening. What's your question?
Hi, good evening. So essentially, I wanted to ask a couple of questions.
Okay.
The first one was related to mutual funds. So any mutual fund scheme, they have a fund management fee of 1 to 2% annually.
That's right.
Whereas if I look at NPS Tier 2, that is 0.01%.
Okay.
And the returns have been quite similar. So what are the pros and cons of investing in NPS Tier 2,
versus
which is a voluntary kind of scheme? It's more like a balanced scheme and can be, withdrawn at any point of time.
True,
It has the same advantages as a balanced mutual fund. So I just wanted your point of view on that.
Very interesting question. Yeah. You get the tax benefits as well, not to forget. Yeah, go ahead, Prakash. Quickly, you had another question.
I'm not looking at the tax benefits.
Okay.
Forget the tax benefits. But in general, because Tier 2 is not that prevalent and not so famous, so your insights would really help there. And the second one was related to Yes Bank. Irrespective of what the market sentiments are, how are the fundamentals of Yes Bank looking? Those are my two questions.
All right. So Prakash, for your latter question, this exactly is not the forum to talk about stock specific. We do have, of course, our show Buy Now, Sell Now, which you could tune into every day at 11 to understand the fundamentals. You can call in live over there as well and we'll get your question answered. But talking about your first question, NPS versus MF, to put it very plainly, and of course tier 2 NPS, if you could enlighten our viewers about that, and of course Prakash's question about how the two differ.
Yeah. See, tier 1 and tier 2, tier 1 is basically a option where you cannot withdraw your money before retirement, except only a limited 25% in some certain cases you can withdraw, but that is meant for pension. But tier 2 is basically like a saving account where you can anytime you can invest, anytime you can withdraw. So your question is specific to tier 2, where you don't get a tax benefit also. But yes, if you see the fund management charges, which are very low compared to even mutual funds. But as when we invest in mutual fund, we have many choices. We can invest in 100% equity, whether large cap, mid cap, multi cap, small cap, or hybrid. But in NPS tier 2, you cannot have the 100% allocation equity. So if you are comparing with the hybrid scheme and you want to invest in that, then definitely you have one choice. You can go for NPS tier 2 also. But when you want to invest in purely in 100% equity, large cap or mid cap, because you have multiple choices when you invest in mutual funds. So, and when you say the 1% or 2% that fund management charges or the total expense ratio, I'll say that more important is how much return you are getting. If your returns from a mutual fund scheme is more than your NPS tier 2, then 1%, 2% does not matter. The cost does not matter. What matters is how much net return I'm getting. So definitely when you want to compare with the hybrid scheme, you want to go for that, you have one choice of NPS. But yes, when you want to invest in purely in large cap or mid cap or multiple different choices, then mutual fund will be a better choice for you.
Okay, I hope Prakash, Mr. Mathpal has been able to answer your question. We just move on because we're getting a lot of calls today. Deepak is joining us on the phone line from Pune. Hi Deepak, what's your query? Deepak, if you can hear me, what's your question? Okay, I think we've lost Deepak's audio. Let's just do one thing. Let's move on to that email query that we had received earlier. That should just come up for you on your screens. Okay, we'll just wait by for that email query. But yeah, again, a reminder for our viewers, you can send in your questions and queries, but we're short on time, so quickly call in. For now, let's take on board the next question. We have Neeraj Thakur who writes in to us. He says, I'm 34 years old and I have an SIP of roughly 36,000 rupees. All his goals are long-term in nature. He's of course young, so he does have time on his side as well. Now he essentially wants to know that he's given us his breakup basically of all the funds and market cap wise. So I would assume that he's investing basically right from large cap to multi-month. There you have it. Large cap is 38%. There were mid cap funds as well that I saw that were invested 30% roughly. And these are the funds that he has invested in: the Mirai Asset Tax Saver, Blue Chip, as well as the multi cap. 6, 7 and 4 grand. Let me just flip over and see if there are any more funds. Yes, 3 small cap funds where he's in totality invested around 12,000 rupees. So I think, Reliance Small Cap Fund. Okay, this is another set then. More small cap funds, and that's a total 22,000 rupees invested in SIPs. It's a very, very big chunk, completely skewed in favor of small caps. And these are some of his goals: child's education 12 to 15 years, marriage 12 to 25 years, and retirement 25 years. A big skew towards small cap. And you know, we as well keep saying that a large chunk should be towards large caps. True. And then you should have multi caps or mid caps or small caps. Is this a good portfolio allocation?
No, I'll not say it's a good portfolio, because most of the time when investors say they are aggressive investor, they think that investing in small cap will give them better returns always. Yeah. It's not like that. In different market cycle, we have seen that sometimes large cap perform better, sometimes mid cap. And because large caps are more stable, I'll say that your 50-60% should go in large cap only. And small cap, when you say, it should be only 10% for a long term. But in this portfolio, because you're missing mid cap, I will suggest you that you should first have only 2 small cap fund. Your large cap and multi cap both are good. Your small cap only you can have 2 schemes: SBI small cap and Axis small cap fund, and discontinue SIP in other small cap funds. Yes, include mid cap funds in your portfolio, and one large cap also you can add to your portfolio. In addition to this, if you want to diversify your portfolio, I will suggest that you can have some international fund like ICICI Prudential, US Blue Chip Fund or Franklin Feeder Fund. So that can be a good choice for you to diversify portfolio, but not like that you are having maximum allocation as in small cap. So have the better stable portfolio.
Oh yeah, in fact, we were speaking about how these US focused funds have done very well in 2019 as well. On that note, we're out of time. So Pankaj, thank you for joining us and patiently answering all the questions and queries. Folks, we'll take a very quick break right here on the show. But when we come back, we're going to be talking about some of the biggest victims of the fallen rupee. And I'm not talking about IT companies. I'm talking about the parents of all those kids who want to go abroad to study. The rupee is depreciating, and that too at a time when we're just starting the academic year. We'll have that conversation with Anshuman Mishra of Loan Adda. Stay tuned for that.